used to have before we transition to SAM. They are based on SAP 104, which is a standard of actuarial practice, which is issued by the South African Actuarial Society of South Africa. If we can move to the next slide. Sorry, if we can move to the next one. Sorry. Yeah. So just to share some of the learnings from South African implementation. To ensure a smooth transition, South Africa did a number of quizzes. It's very important to have these quantitative impact studies. It's very important to have parallel reporting to prepare the industry. There were a number of forums that were set up by the regulator. There were a number of forums that were set up by the Actuarial Society of South Africa, where the new regime that was being proposed was discussed. It's very important to have that discussion, preparing the industry to check if whatever we are adopting from Europe, is it suitable for the market that we operate in. And you need to consider appropriate timelines. You need to give companies time to implement. Industry involvement is very important for you to have the industry involved. It's very important to have buy-in from the various players in the market. In terms of cost, it can be very costly. We have seen similar projects such as IFRA 17. Those who are busy implementing IFRA 17 knows that IFRA 17 is a very costly project. There are a lot of learnings that companies can learn from IFRA 17, particularly those that are implementing. There are a lot of leverages that companies can get, for example, from IFRA 17, particularly those who are implementing a risk-based capital regime that is based on best estimate liabilities. The assumptions under IFRA 17, not all of them, they are very similar. Maybe the different assumption is attributable expenses and maybe discount rate, but there are a lot of similarities there. But in terms of the cost, the long-term benefits outweigh the cost of implementation. The regulators that we have spoken to, they say the long-term benefits outweighs the cost of implementation. They benefit from risk management, they benefit from transparency, they benefit from OSA reporting. There's a lot of benefits in applying risk-based capital regime. In terms of time, it takes time to update regulations. I'm not sure in other countries, but in my country, before you update regulations, it has to go through Parliament, and it takes time for Parliament to approve. There are a number of things that parliamentarian looks at that the lenses of actuaries, we sometimes overlook them. So it takes time for you for Parliament to approve. So allow for time in your planning. In terms of documentation, it's very critical to have documentation in terms of methodology, assumptions. How are you calibrating that risk-based capital regime? As I indicated, most countries borrowed from Solvency II of Europe, or they borrowed from China, America. They are borrowing from what South Africa used to do. How do you then calibrate it to what to your market at home? So it takes time. You need to explain how did you arrive in that calibration. South Africa has implemented solvency and asset management, but there are still challenges. Over time, there's still improvement that needs to be done. So what the learnings there is that focus on the material issues first. There are certain things that once you have implemented, you can always fix. Don't try to fix everything at the start. Focus on material things. There are a lot of things that will come up. There are new products that new features that maybe your particular regime, new risk, emerging risk that you didn't allow for that. So you need to continue collaborate it, continue change it, but it's very important for us to have this risk-based regime to align with the global world and to ensure transparency, to ensure the protection of policyholder, and to give confidence to the investors. I'll hand over to Kwabena, who is going to talk about looking ahead to implementation. If you can please go to the previous slide.
Okay, thank you. I think you can put your hands together for him. So, who is against risk-based capital here? I've asked that question when I go to some insurance company and I ask that question. The answer I get is, why do you want to destroy the industry? And they say, our industry is not matured enough. So the question is, can the industry be matured enough to implement risk-based capital, or it must be implemented now? Should we wait? And what do you mean by the industry is not matured enough? So the question is, at what point do you implement this? And looking ahead, there are some key things that you need to learn or you need to consider when it comes to implementing risk-based capital. The first is with respect to the capital implications. Remember, even in Ghana, the minimum capital they have now prescribed for insurance companies is forcing companies to merge. When risk-based capital is implemented, it will even force companies to merge further. So I understand when they say you are trying to destroy our business, because you are forcing, and you know the thing is about how are we protecting the policyholders. You do a minimum capital, they meet the minimum capital, you go and take on a business that exposes, the company, and then what happens to the minimum capital? So I think, to me, risk-based capital is the way to go for our country here. I don't know if you have a different view. If we get to the Q&A session, you can let me know your view, and we will see. So it has capital implications. Yes, we should be thinking of merging companies if the need arises. When it comes to multinationals, for example, internally some are reporting using the risk-based capital already. So for them, moving to risk-based capital as an industry will be easy for them. The skills required, the technical skills required is also very, very key. So as much as possible, you will need to up your game. The internal technical experts need to up their game. So that is one of the things that needs to happen when we are thinking of risk-based capital. Then when it comes to the industry as a whole, yes, there will be need to train. I think Takalani mentioned about impact assessment that needs to be done. Yes, and someone here said this risk-based capital is money for consultants. I agree. I agree because the insurance industry is a regulated industry. So if you need to decide, either you are in or you are out. So that is it. So I agree. We will do the impact assessment. We need to develop the models. You see, the models, even if you develop it internally, must be reviewed. And there must be some assurance that we need to provide on the models you develop internally. So that will also come. So it then leads us to saying, does the cost then outweighs the benefit? Takalani also said, in the long run, the benefit will outweigh the cost, because the risk-based capital enables the regulator to understand the risk and to monitor it well. So that is one of the key benefits, because you need to understand the risk, and the risk-based capital will help you to understand the risk and for you to manage it very well. When it comes to leveraging on what is currently happening, which is the IFRS 17, yes, we can learn lessons. And I think Takalani also said, especially if you are using the BEL, that is best estimate liabilities, to do some of these calculations under IFRS 17. Lessons can be learned there, and then it will help in a smooth transition. So, lastly, the cost of implementation and compliance can be significant. Takalani also said, even under IFRS 17, there are huge cost implications. You need to think about not only the manpower that needs to do their job, the IT system will also have to be looked at. So these are all costs that needs to be considered when we move into the risk-based capital. And I think that is the best way for most African countries, because it helps us to understand the risk we are dealing with when we take on these businesses, and then how we monitor these risks. So that is very, very important. So my question again, who is against risk-based capital? Let's go to the responses. So we conducted some research, some survey from some regulators. We try to see what the industry is thinking. From Deloitte, we always try to look into things ahead of time. Yes, that is Deloitte for you. We do that. So look at some of their responses based on the questions that we wanted them to answer. So one of the questions was, why are you considering adopting a risk-based capital regime? Some responses, and you can see clearly here that one is saying it will enhance protection of policyholders. That is their main objective. One also said managing risk. Another said enabling the regulator to identify weakly capitalized institutions very fast. So ensure improvement in the quality of asset that what insurance also hold. And then another one also said to ensure players deal with highly rated reinsurers. And then that same question, another regulator said it encourages the players to promptly settle claims. So that was some of the responses we received from that question. Another question was, in your view, what are the criteria that a risk-based capital regime should meet? And in summary, the response is that said that the risk-based capital is commensurate with the nature, size, and complexity of the risk borne by the regulated entity. So that is the response we received there. Then, what are the challenges that you are experiencing with the existing reserving and capital regulations? Responses received: the need for more capacity building and expertise for the internal actuarial function of the company, because due to the requirement to use what? Scientific and actuarial methodology for reserving. So they identify the need for capacity building, need for enhancement of IT system. And I will tell you here that even with the IFRS 17, the cost implication alone for the IT system is something else. So we need to also be thinking about the IT system, and that can bring in some cost. And then new challenges brought about by the IFRS 17 requirement, because the IFRS 17 requirement also has its own implication. So you need to consider what the 17 is bringing on board, and then you also have to look at the effect of this risk base. Then other questions that we posed and the responses: are you leveraging off the learnings from other countries like Europe, South Africa? And I think we had a very big yes from all the regulators that responded. Then we also asked, does the insurance industry have sufficient experience and knowledge to implement the risk-based capital? The response, in summary, as expected, the industry participants that do not have the technical expertise in-house, and I like this response. I like this response. Don't you like it? The consultants in the room. So, as expected, the industry participants that do not have the technical expertise in-house may seek help from the external consultants or international partners where applicable. So, that is a very good response. Does the perceived cost of implementing the risk-based capital outweighs the benefit of the risk-based capital? Then the ultimate benefit for the response, or the ultimate benefit, I think Takalani mentioned it, the ultimate benefit for the industry as a whole outweighs the initial cost. And I think another respondent said no. Actually, the cost of the company's failure is much higher. So you could clearly see that the overall response was very positive, and we think risk-based capital is the way to go. And I ask my question again, who is still against risk-based capital? Any hands? So we are all in together. So risk-based capital is the way to go. Thank you very much. And I think we'll take some questions, one or two questions, and then we will say bye-bye to you. So you could, my name is there, Kwabena Situ. I'm the assurance partner for Ghana. Takalani is based in South Africa. Hagar is based right here in Ghana. Thank you very much, and we will take some questions. Any question for us? Okay, there's a question back there. Can you, the speaker, the mic? Okay. Okay, please go ahead. Is the speaker on?
Yes, 1, 2.
Okay.
Thank you. Thank you, panelists, for a very fascinating presentation. So I have a question, but I'll start with a commentary. Normally, when I've seen Africa adopt a methodology or a different culture, I think we go from 0 to 1 very fast. And I'm thinking, if we have thought hard about phasing this out so that this is not too burdensome for the regulated entities. The second thing is, have we thought about customization? Because copying verbatim, and I've seen it done many times here, is normally not optimal. We have to customize it to the realities of the African economic environment. And the third thing that I would also like to hear your opinion on is, it is a huge change, and sometimes you can pick, there is something called Pareto efficiency, and sometimes you can pick 20% of the changes to cover 80% impact. So have we made sure that, have we done any studies to know what are the material changes that have to be adopted in the short term so that we don't blindly download all of it, whereas we could just download 20% for an 80% impact?
Thank you very much. Probably, let me start. You know, it's a journey, and you need to start the journey. And I think Takalani also mentioned that we need to also look at conducting an impact assessment to assess the gap. And then once you assess the gap, you know what needs to be done. So with respect to customization, yes, there needs to be customization. But that will only come when an impact assessment has been conducted. So that needs to be done. Takalani, do you want to take up the other one?
Thanks, Kwabena. I think that's a very good question. And if I to think about it, if I compare risk-based capital development with IFRA 17, for example, IFRA 17, the whole world have to implement at the same time. So we are all learning together. But with Africa on risk-based capital regime, there's a number of countries that have already implemented. So we can take the learnings from them. We can, so that we don't repeat the same mistakes that they have done. That we don't go through the same challenges. And when we ask the regulators, they were saying that they have been chatting to countries that have already implemented so that they can get the learnings. And another thing that we have seen is that they are doing it in phases. As a start, most of them have started by increasing the minimum capital requirement so that in preparing the industry to say the risk-based capital regime is coming. If I look at Morocco and South Africa, for example, there was a number of there are a number of quantitative impact studies that are happening to prepare the industry and discussion forums where the industry gets involved to calibrate so that we don't just take from another country and apply. So there's a lot of industrial involvement that's coming. And if you look at the three pillars approach, in South Africa, it comes with a standard formula or a standard model that everybody can use. There's also allowance if you want to develop your own internal model as a company that you want to use if maybe your risks are not in line with the average risk in the market. So there's that leeway for those companies where the risks are not standard. So the regulators have been considering that from the discussion that we had with them.
Thank you. I hope you are fine with the response. Okay, great. So, okay.
Okay, thank you. My name is Melo Sibaloy. I'm a consultant in Johannesburg. Thank you for the presentation, quite insightful. I do have challenges with the amount of money that I saw on the screen, particularly if you are looking at it from a perspective of financial inclusion. I had challenges with the South African amount of 15 million minimum. It just makes it almost impossible for locals to get into the insurance industry. And you know, as much as you have a lot of multinationals getting into each of the spaces, into each of the countries, you also want local participation. So maybe I'm uninformed in terms of, you know, what's the thinking that sort of leads to some of these amounts that we see, you know, is what process is followed to get to that? And what's the balance that's being struck between the protection of policyholders, which I assume is the driver of this, together with the need for financial inclusion, which I think is also a very important topic on its own. So I'm curious to know if you have some insights around that. Thank you.
So, okay, thank you very much. So, qualitatively, is to protect policyholders. So that is the qualitative side. Quantitatively, how do you get to the figure? So Ghana, we are dealing with 50 million, right? So you go and ask, how do you derive the figure? Some will say there's a political thing to it. Some too will say, looking at the economy, and you probe further and you try to ask them, what are the specific indicators that you considered that made you to arrive at the figure? I'm here to get an answer. Myself. I'm yet, I've not seen, maybe I'm speaking locally here. I've not seen a formula that they said, okay, we put in A, B, C, D, and then we arrived at this. I've not yet seen it. So I would say, ultimately, is to protect policyholders. But as to how they got that figure, Takani in South Africa, is there a formula or is politically influenced?
So I agree with you, Kwabena. It's a challenge throughout. I've seen in other insurance products, such as, for example, medical schemes in South Africa, where they allow new players to build capital over time, so that they understand that the minimum capital requirements can be onerous for new entrants. So they do allow for that transition. It's a challenge, as Kwabena indicated, even for existing players. When you move from 15 million today to 50 million the next day, sometimes it might mean that you need to go and ask for money from the pockets of the shareholders, so that you can meet those capital requirements. And as Kwabena said, we might see an increase in mergers and acquisition, where those companies who are not able to meet the minimum capital requirement, they seek a partner, they get merged, and then they can meet the minimum capital requirement. But it's a big challenge for many countries. Given that it takes time to update regulations, that minimum capital requirement hasn't been updated for a very long time. And with the exchange rate, the value of our domestic currencies going down to the dollar, moving it forward is just to counter the effect of inflation, to counter the effect of exchange rate movement.
Yeah, so I think, so basically, he was trying to balance. So what about the financial inclusion? Looking at this minimum capital that is always being increased, is there actually financial inclusion? Probably I'll say there's financial exclusion.
In South Africa,
Yeah.
In South Africa, for example, I'm not really too familiar. So there's microinsurance regulations that deals with products that are designed for the low-income earners, because there's an understanding that the capital requirements are very onerous, and also the risk-based capital requirement, they come up with new roles and responsibilities. Suddenly, you need to have the actuaries signing off the pricing, signing off the valuation report. You need to have a chief risk officer. There's a lot of assurance that comes into play, and over and above that capital, it's a lot of work. It's a lot of money employing an actuary, employing these professionals. So the regulators have introduced certain regulations for microinsurance players, in understanding that some companies, they might not be able to meet these capital requirements in a way to have that financial inclusion. And when these microinsurance companies are able to meet that capital requirement in the future, then they can move to an insurance licenses.
Yeah. All right, thank you very much. I think
We have.
okay. Okay, one more question, and I think our time is up. Yes.
Okay, I'm Roland, SIC Life. Okay, I want to, I think increasing the minimum capital requirement is good, but it's like a lot has to be done to safeguard insurance companies eroding as a result. For instance, if you look at it in terms of life insurance, you realize that there are a lot of undercutting. And this undercutting is being influenced by brokers trying to put pressures on various insurance companies. They'll go from A to B, and then they'll try to shop the market, and then at the end, you the insurance company, will be compelled to give the business out in exchange of smaller premium. And if you look at it, for instance, general insurance point of view, it's like, let me say, third party. They've been able to come out with common premium that wherever you go to, you get it at the same premium. But for us at the life insurance company, will be forced by the manipulation of these brokers. So my question is, what is NIC and then actuaries doing to be able to prevent this challenge? Otherwise, at the end of it all, if we increase this minimum capital requirement, we'll end up using it to pay claims.
Okay, so just a quick one before Takalani comes on board. So this thing of undercutting and all that, I think one of the things that, or the issues that IFRS 17 will really solve is that, because with IFRS 17, you know, it goes a long way to test how good your pricing is. So if you are undercutting, it will actually be revealed when you do your bill and all that, and it comes into the account. So IFRS 17 will help you solve that in a way. But as to the other effect, what is NIC doing on undercutting and all that? Yes, they'll bring the rules, but at the end of the day, it's your business. And if you are reporting in line with IFRS 17, for example, then if you are not pricing well, it will be revealed. It will be revealed. So that's why we are also trying to tell you about the effect of the IFRS 17 on all these capital requirements. So IFRS 17 is a good way to start. The others will follow. Takalani, what do you think?
No, I agree with, especially for short-term insurance products under IFRS 17, you need to, if facts and circumstances indicate that there's a chance that you have loss-making business, you need to indicate that you have loss-making business, and for you to quantify that loss, it requires you to track it down, to report it on the income statement and on the financials. So there's a lot of work that needs to be done for contracts that are loss-making. So it will help reduce that problem. But the pricing has to be done by insurance companies themselves.
Yeah. So I think that is all we can take for now. And thank you very much. And who is still against risk-based capital? Thank you.
Thank you. Thank you, Takalani, Kwabena, and Hagar. Next, we have micro-insurance trends in Africa, the future actuaries role. To present this is Mr. Francis Gota of Ayo, Ghana. Please welcome him.
Good afternoon, ladies and gentlemen. Kobi, if you ask me that as an actuary, how did they arrive at the 50 million minimum capital? Me all I'll say that, let me mind my own business. All right, ladies and gentlemen, thank you for the opportunity to present to you on microinsurance. I will share just a brief about microinsurance based on the trends in Africa and the role of the future actuaries. what do actuaries do best? We design nice products, and we get paid a lot of money for it. And sometimes people say that, you guys are so complex, but you charge so much. Of course, complexity comes with a lot of money. Why do you think so? Anyway, so with microinsurance, it's something that has gained popular, that has become very popular, and a whole lot of people are venturing into microinsurance now. Thank God. 10 years ago, it wasn't like that. I remember the first mobile microinsurance product I saw was at the NIC, when microinsurance came to submit their product for approval. It was something new. But now, I think we've made strides. Great progress has been made, but still there's still more room to achieve greater ones. And as actuaries, it's important that we understand the business that we are venturing in, and we are being paid a lot of money to develop. So, I will start with the definition of microinsurance. 2 days ago, Manchester, when did we go for the radio interview? Monday. We were in a radio interview, and my president was defining microinsurance. He said, simply put, microinsurance is for the villages. Village insurance. And I was asking myself, village insurance, Manchester, you come from Accra, this is your village. Are your people poor? They are not. Simply put, microinsurance is basically for low-income people and micro, small, medium enterprises. And it's a product that has been designed to offer protection against specific risks that people in the low-income brackets actually face. So it's a specialized area, but not only do we design the product for those segments, but it also needs to be affordable. In any case, we claim they are low-income people, so they should be affordable. And it should be accessible as well, because we are driving financial inclusion. Financial inclusion basically says, don't leave anybody behind in the financial system. It sounds more like a title of an American movie, where the soldiers come in, go, they do the invasion, they kill one, then it's okay. Let's send 100 people to come and rescue the one that is dead and left on the battlefield. So we are not leaving anybody what? Behind. Repeat after me, we are not what? Leaving anybody behind. But it's for low-income people, making this affordable. People have to provide it, me and you have to set up insurance companies to provide it. So it has to be what? Sustainable to the provider. Now, it's important we understand the kind of people that we are serving with the microinsurance product that we design. These are basically irregular income earners, reside in the informal sector. In Ghana here, the informal sector is a bigger part of the economy, even though the rate is small. It's a sector that is highly vulnerable to risks, and they are underserved. Exposed to high-risk living environments, low security, they are more vulnerable, looking at the nature of the job, etc. They have low and no financial literacy. They have also misconception about insurance. You know, those people, they say, oh, insurance people are thieves. You say that when you die, we pay. Somebody died, we didn't pay. But they forgot that there are terms and conditions. So there are special people that we need to make sure that we understand them before we offer them whatever service that we do. And to them, they don't define insurance as small in their mind. It's a big thing. It's for the educated. It's for me and you, those working in the formal sector. That's how they perceive it. If I had not joined the microinsurance business, I would have seen something very unique. Who can tell me what triggers death claim? When do we pay death claim? When somebody dies on the policy. And if you say that the person dies, we pay. All that the person needs, you need to prove that the person insured is what? Is dead. So guess the document that they submit for claim. That is basically somebody's father who is dead, and they are organizing a funeral. So there's a picture of the person dead in a coffin, and the person submits it for claim. In any case, you say that what? When the person dies, we do what? We pay. That's it. If I want to automate the processes, I'm wondering how I'm going to capture this so that artificial intelligence will just see it and check with whatever is in the system. Oh, this man looks like he's dead and he's insured. Then we pay. And when it comes to hospital cash, what do you see? You say you get sick, get admitted at a hospital, and we pay. So, to the settlement that you are serving, he wants to prove to you that he or she actually got sick. He was admitted, so he sent a picture of what? Herself, the hospital. That's the evidence that, you know what, I got sick, I got admitted, so please pay my benefits. So these are special people that we are dealing with. It's very important to understand the market that we are serving. The next slide. So with that in mind, microinsurance strive on this principle that it needs to be simple as ABCD, no crazy terms and conditions that says that, oh, when the person dies, you need to go and bring death certificate signed by the doctor and all those. So to that person, it says, when the person dies, you pay. So if I submit my grandfather or my father who is dead and is insured, you need to pay. You need to design the product simple. It should be easily understood by the client, and it should be accessible. In any case, we don't want to leave anybody behind. So whatever that we design for them is accessible, and it has to give value to the customer, meet their needs, their low-income people, and it has to be delivered in an efficient way so that it will be sustainable to the provider. Microinsurance is so special that even the G20, they added it to their financial inclusion agenda, which basically says that we need to give equal opportunity to what? Everybody. Everybody must have what? Access to financial system. Must have a transactional account, should be able to buy insurance. Why should only Manche be qualified for loan in Ghana? At least my mother who sells tomatoes at Aboble, she also qualify for it. So it's so important that it's captured there. And it actually addresses 9 of the SDGs. No poverty. I'm looking for the day that there won't be any poverty. That would be exciting, huh? Zero anger. I hope what is happening in 2 places I know will not resort to anger. Good health and well-being. Gender equality. Decent work and economic growth. Of course, when people have peace of mind that they are protected, they can go about their daily activities, with pride and make more money. So that we don't always fall on the government when things happen that, oh, there's fire at Makola, and they come, government, please give us money to support it. Also, Goal 9 talks about industry, innovation, and infrastructure. Reduce inequality, climate change is something that is always coming. And also partnership for the goals. Now, if you look at the trends in microinsurance, if you look at the product, it's basically started with simple credit life product. People issue micro loans. They add a bit of charge to it to give you credit life, and moves to embedding it with funeral policy. So you see that people, especially the microfinance, design special products, savings, and they will add a bit of life cover to it. They will add a bit of family funeral and stuff to it. And now we added hospital cash. Hospital cash benefits is one of the things that is gaining popularity lately. If you look at IO, for example, hospital cash constitutes about 60% of our portfolio. And others are offering personal accidents and agric insurance. But of course, agric insurance is very sensitive that, in my own opinion, for you to succeed in that, you may have to get some government support. And it's areas that people are trying. I look forward to seeing our agric insurance pool doing the same, or they can come to me, government to give me small money, I'll offer that insurance for them. In terms of the premium, it started with cash. Then, as I said, we embedded it into other products that financial institutions were offering. But for Ghana, for example, we get Bank of Ghana to accept that we can actually monetize airtime and use it for insurance purposes. And that was a game changer in our market. So you can actually buy insurance and pay with your airtime, you know. And what basically you're doing that, sometimes we like too much gossip that we are comfortable buying more airtime to gossip than saving some money to buy insurance. So you leverage on the behavior of people to give them insurance. And thanks to WhatsApp and co, you need to buy more data and stuff. So we are looking at how do we even get people to pay for their insurance using the data that they get. Mobile money. When our colleague from Bank of Ghana came, he said mobile money, we forgot how much, 76.2 billion Ghana cedi. That's a lot of cash, you know. And mobile money is a key enabler in microinsurance in Ghana here, and most of the countries in the African continent. If you look at the distribution, it started with the MFIs, the microfinance institutions, partner with insurance providers, because they actually serve the low-income people. Then the MNOs came in, that's the mobile network operators, and that was also a game changer. So if you see mobile insurance, it's a big thing. If you take a company like IO, we started somewhere 2017, 2018. Less than 5 years, or within 5 years, we shot about almost 7 to 8 million Ghanaians. What is Ghana population? Somewhere like 31 million. I see Beauty is Intelligent is looking at me. He's wondering, why don't you partner with us? We'll have that discussion after this. So it's actually a nice opportunity. It's something that we've done that is been very successful. I see the likes of the Bima also doing it, and it's been great. Thanks to COVID, which taught us hard lessons. It was a blessing in disguise. It also challenged us to explore other ways of distributing insurance solutions rather than the physical, face-to-face, you know, then that people sometimes will look at the way you look and your shoe before they buy your insurance product. Now, we have telesales that we actually can sell insurance just over the phone, you know. And it's quite an interesting experience. I remember in my early days in IO, when I set up the call center, I said, no, when I'm bored, let me go and sit at the call center and make some calls and sell insurance. You'll be amazed by the greetings that you get. You call the person, hey, we are Crawford, we are fraud, you know. But you need to take your time and convince the person it's not actually fraud, but you're actually selling insurance to you, blah, blah, blah. And now it's one of the most profitable channels that you can use to distribute insurance. Because a lot of analytics also goes into the data that you get, or the lead that you get to call the customers. Then, of course, we have the NGOs and the businesses like I, we are a technical service provider. Me, I'm not an insurance company, but I leverage on the insurance license of our partner to offer relevant, accessible, and easy-to-use insurance solution to Ghanaians, so that we can achieve a future where everybody uses insurance. You see, the tagline, leave no one behind, is very special in everything that we do. Then we have the brokers, of course, the rural banks. Now with agri insurance coming, or with agri insurance being offered in places like Kenya and Co, we embed insurance in some of the farming tools that so you buy fertilizer, you get insurance cover. You buy machete, you get insurance cover. You know, special way, basically. Then I'll talk about the mobile insurance. So if you look at mobile insurance, or mobile micro insurance, is basically selling insurance or distribution insurance through a telco partner. It started with, as a loyalty program, that's what you call freemium, where the telcos actually use it to drive ARPU. ARPU is average revenue per user, and also reduces churn. So let's say, I can say the MTN, in order to make sure that the MTN customers stay, I say, if you come to MTN and you stay on the network for a certain number of days, you get free insurance cover, in addition to your airtime and stuff that you buy. You know, you get free insurance. So that was the model that started. We use it to get people to appreciate it. Then we transitioned to paid policy through your airtime or mobile money. So you could see that the model started at freemium, then they came with airtime deduction, and mobile money, which were more of transactional in nature. But even mobile money, there are other things we do, like we leverage on the remittance behavior of people to offer insurance. So basically what you do, offer insurance through, by leveraging on the behavior, the regular behavior, day-to-day behavior of the users of the platform. So that's basically what we do. And that has actually proven to be a success. Of course, we have close to 8 million Ghanaians who are insured by us alone. So I would say it's a success. Now, as actuaries, we also have to understand that, I would say 10 years ago, if you go walk to an insurance company, tell them that they should invest in microinsurance, they will look at you and say, the premiums are very, very small, sometimes like $1, less than $1. Why should I spend my time and resources to go into microinsurance? So you need to actually convince the decision makers about it. And how do you convince them, making sure that whatever that you are designing is profitable? So I put this together, a recipe for microinsurance business, thanks to Microinsurance Masters that share it in the webinar. So you need to be organized for innovation. That's basically it for the first time. If you have not been in it before, you need to be somebody who is open-minded to embrace innovation. And sometimes innovation doesn't come cheap. You know, you need to take part of your 50 million capital and probably put it into innovative ideas to drive microinsurance, and every time you make your money. And for that, as I said, with the amount of money involved and the fact that the premiums are small and you need skill to actually be profitable, you need to really get champions in your team, especially the decision makers. You need a sponsor. So you go to the board, at least you've gotten to one person that actually believes in it, then that person will champion it for you. If not, it's usually difficult to convince the board and the shareholders to actually venture into businesses like microinsurance. You know, it takes the brave and the courageous to do that. And as I said, microinsurance is very special, so you need to learn to unlearn. So most of the people who are in the traditional, I was in the traditional insurance, a typical one, you know, and I need to transition to microinsurance. There's so many things that I have to unlearn. Because the microinsurance business, you are looking at small premiums once again. You are looking at people that you tell them that when you die, we'll pay, provide me evidence of death, and they will bring a picture of the person who is dead and expect that you pay. You know, so I have to, let's go so many things, see how do I best serve this segment, which are so special that we don't want to leave behind. In addition to, you need trusted partnership. Most of the time, we design a product, then we come to you and say, oh, Snit, I have designed this product. I think that we can partner and you can drive it. And you earn commission. What is the probability that the next person that comes and tells you that we've designed this product, but instead of 10% commission, I'll give you 20%. What's the probability that you will not switch to it? So, in forming the partnership, it needs to be centered on upgrading the core business that the partner is providing. So, let's take credit life, for example. If you go to your bank and say, well, let's do credit life insurance. Why should I do credit life insurance? It's okay. We will secure the loans that you are insuring so that your non-performing loans will not be impacted by the demise of the person that is taking the money. You make sure that whatever that you provides fit into the value proposition of the business. So it's very key. Then co-owning the program is usually important. That you design the solution together, you co-own together, then you are in it together so that if the next person comes and offer a bigger commission, you will just change, you know, or switch. Then also you need to compete on value. But in all this, who are we serving? The customer. So we have to be customer-centric. You need to really know the customer that you're dealing with. And whatever that you provide must meet the need of the people. Next slide. So as actuaries, we know that for microinsurance to be successful, one of the key things that you need is scale. Premiums are small, like $1 a month or less than $1 a month. how do you then cover the cost that you are providing, the service? That is where skill comes in. You need a lot of people. So you need to design it in an easy way and deliver it in a very accessible way so that you can actually rescale. And that is where technology comes in. Technology is a game changer. Most of us here, almost everybody is having a mobile phone. Show by hand if you are not using a mobile phone. And I can bet that we have quite a number of people here having more than one mobile phones. Somebody said jokingly that in Ghana here, mobile phone penetration is 130%. So, if I assume that everybody have one toothbrush in the house and mobile phone is 130%, that means we have more people having mobile phones than what? Toothbrush in Africa. So, technology is it's a key enabler, and that actually enables you to what? Drive skills. For you to be profitable, you need no claim costs. And no claim costs means you need to be able to verify the claims easy. Just imagine that you sign up to an insurance policy. The insurance system is integrated into, let's say, the National Health Insurance Database, National Identification Authority, and somebody goes to the hospital, or somebody insured on your product goes to the hospital, then the person, unfortunately, doesn't make it. And they record it in the system. But because your systems are integrated, as soon as it's recorded, it triggers to you that Mr. B or Mr. A is dead. Then, because it's coming from the hospital system, it triggers your claims process and pays to the beneficiary. So before the beneficiary even realize that the person's claims have been paid, just imagine that future. Or you go to the hospital, as soon as you are, when you are discharged and they process your stuff, you get an alert. Your claim has been paid to your wallet. Just imagine, and that is what we're talking about. Leveraging on technology to achieve that. And it requires a lot of lobbying. It requires a lot of partnership, which I believe that as industry, we can do that. We can make a case. In any case, we say we are doing what? Data-driven what? Economy. And with a low claim cost, another thing you need to look at is minimizing the operational costs. The premiums are small. The margins are very, very, very small. So what you need to, however it is delivered, you need to make sure it's delivered in such a way that your average cost is extremely low compared to the average revenue. So technology plays a role there. And the most important thing is what? Is the customer experience. We are serving the customers. So the experience has to be special because you are serving special people. And that brings my last slide. What could be more important than providing insurance to help someone rebuild their life after a catastrophe? In particular, if they are already in a low-income segment. They are vulnerable and they are what? Underserved. Microinsurance actually does. And it's something that we actuaries, we shouldn't shy away from venturing into that sector, developing products that make sense, developing products without our traditional insurance product development mindsets, but you really get to know the people that you are serving, you really get to understand them, you get passionate about it, and I'm sure your employers can afford our salaries. Thank you very much. I'll pause for the questions. Two questions, because I'm hungry. Mr. Moderator, in order for me not to be biased, I think you have to direct who.
1, 2.
Okay, somebody has taken the lead.
Hi, my name is Jesse Dapa, and your last slide was really, really fascinating. It's really a game changer if we can make that happen, and I wish you well on every step of that journey.
Thank you.
I have a question for you. So, is microinsurance regulated? And how do we ensure that it's adequately capitalized so that there is no solvency issues. And more importantly, if I can squeeze in one question, the customer base is not sophisticated, and so how do we protect that policyholder from overly excessive or unreasonably aggressive claim practices or even fraudulent claim practices, so that someone files a claim, and because you know that he or she is not sophisticated, you try to get out of contract and not meet that contract?
So at this 21st century, I'm wondering which insurance company, I'll take the last one first. At this 21st century, I'm wondering which insurance company will have a claim philosophy of reason not to pay claim rather than reasons to pay claim. For my business, we find reasons to pay claim. That is why even when you send a picture of the person who is dead, it is our responsibility to go and check and make sure that we pay the claim. So for that, I think it's all boils down to the business philosophy. And also our industry is well regulated that I don't think that practice will suffice in our environment now. Probably many years ago, but now from what I've seen, I think there's been a significant improvement. And in any case, all of us in insurance, are we not selling the same thing? It says when you die, you pay. When you survive, we pay. That is if it's an endowment. If it is health, it says when you get sick, we'll pay for you. So what will be the difference between us is what? The customer experience. That is what will make somebody who goes to company A and company B. So if you compromise on your customer experience, then I'm sorry. I think you don't have a sustainable business. You don't have a sustainable business. So customer experience is key. The second question that you asked is about regulation. Yes, it is regulated in Ghana here. Ghana here, you can't sell any insurance without not being regulated. And nice, you come and cut your head. And the other question was, pardon me, there were 3 questions. I've covered it. Oh, thank you. Now I can wait.
Okay. Thank you very much. Andrews, Investor of Professional Studies. Okay. My question is regarding the mobile, e-levy.
E-levy.
So that's what I want to know. Are your customers simply the impact so far, and how do you see it, worrying your innovations?
The nice thing about
and how many mobile, these mobile companies are you using? How many of them in terms of the channels?
So let me add my question so that you finish it up. I'm here. I'm Samuel Jamra from Kwame Nkrumah University of Science and Technology. So I was doing a pre-survey on the willingness to buy index insurance for farmers in a village in the northern sector. So I came across this woman, and immediately she told me that, you guys, insurance people, you come here, you subscribe, you don't pay, and all those kind of stuff. So I asked her if maybe she has an experience, and she told me yes, she subscribed to this telecom insurance. I don't want to say it. And it's like she was sick and she was admitted, and it's like she called them and they didn't pay. So I asked, did you submit any documents indicating that she was sick and she was admitted? She said no, she didn't know about it. So that is to say about you showing us the picture of someone who is dead. And I was wondering whether microinsurance, you guys go to the ground to educate them. These are non-formal sectors. They are not well educated about this insurance. If you go there to educate them that you need these documents when you are sick and you are admitted, you want to have a claim, you need this document. When your family dies, you need this before you can claim. So I think in order to avoid all those kind of hiccups, maybe we need to do more. Go down there and educate them that this is what you have to do, because clearly this woman didn't know a lot about the procedures to go through to claim what is due him or her. Thank you.
Thank you. In terms of insurance education, so if I look at our business, for example, we spend so much. You should see my marketing budget. So huge. You know, because the segment that we are serving, they need a lot of education. As I said, some are low financial literacy. Even some they don't have it at all. So we spend a lot on education. But of course, no amount of awareness creation and education is enough. If you look at the insurance industry, we have the actuarial IACG, Insurance Awareness Creation Group, right? Which I remember. We spend so much doing insurance education. So if you watch TV3 on Sundays, we have insurance-based campaign, which is ongoing. So it's something that is a work in progress. We are actually doing a lot, and we are committed in doing more to make sure that the people really understand when to claim, how to claim, and what you are claiming for. You know. So for our business, we use a lot of tools. We have IVRs in various languages that when you call, you actually listen to how to go about it. We do a lot on radio campaigns, going to educate people. We do a lot of community engagement and stuff to make sure that people really know when to claim. In any case, I'm in the business of providing a future where everybody uses insurance. So that is it, and that is my KPI. So we do whatever it takes to make sure that they are well informed about it. Please, your question again. I was so excited about the education that the e-levy. E-levy. It's still early days. For if I look at our business, where I've seen a decline in the mobile money dependent products. But one exciting thing about Ghana is that sometimes things happen initially the first week or 1 month. Hey, everybody talk about hey. But let's see after 1 month or some 3 months, I'm sure everything will settle. We'll get used to it. So the early stages, it has actually impact on the transaction, but I'm confident that we'll bounce back. You know, today I was paying somebody, and when I saw the e-levy, it's like 30 Ghana cedis. If I compare the opportunity cost, if I have to take car from where I am to go to wherever he is and go and give him the money, I think it will cost me more than actually sending the money and paying the e-levy. It all boils down to choices. So currently, it's impacting on it, but I think we will bounce back. Prof. So, and one thing too, when it comes to insurance, e-levy is not, e-levy doesn't apply. If you pay through, if you are a registered company with GRA, you pay your tax, payment to you doesn't attract e-levy. Insurance premiums too, they are non-taxable, so it doesn't. So when the person paying premium to you, e-levy doesn't apply. When you are paying claims using the mobile money, e-levy doesn't apply as well. It's just that people are not actually using the mobile money because they think that, you know, when all the buha around the e-levy, so most people even withdrew their money from the wallet and stuff. So that will actually reduce the amount of money on the wallet for people to use it to pay their insurance premium. Now we can go and eat. Thank you very much for your attention.
Thank you, Francis. We shall have lunch break and networking session at the Sankofa restaurant. And we shall come back around 2:20. Thank you, but let the networking continue. Thank you.